What if I told you that the key to getting rich isn't about taking big risks, but about minimizing them? That the world's best investors, people like Warren Buffett, Charlie Munger, and Mohnish Pabrai, don't gamble with their money. They bet only when the odds are stacked in their favor. This is the essence of Dhandho investing, a simple yet powerful strategy inspired by Indian entrepreneurs, particularly the Patel community, who built massive wealth by following a single principle. Heads, I win. Tails, I don't lose much. Sounds too good to be true? Well, it's not. In his book, The Dhandho Investor, Mohnish Pabrai breaks down this low-risk, high-reward approach, a method that has helped him and many others generate massive wealth while keeping risk to a minimum. This isn't about complicated financial theories or Wall Street jargon. It's about real-world business lessons, from Patel Motel owners, Richard Branson's Virgin Empire, Warren Buffett's biggest bets, and even the great warrior Arjuna from the Mahabharata. By the end of this summary, you'll have a crystal-clear roadmap to investing the Dhandho way, where you check buy great businesses at bargain prices, check look for massive upside with limited downside, check make a few but highly calculated bets, check and let time and compounding do the rest. If you're ready to think like an entrepreneur, invest like a billionaire, and build wealth without unnecessary risk, then you don't want to miss this. Let's dive into The Dhandho Investor. Chapter 1. Patel Motel Dhandho. Picture this. A family of Indian immigrants arrives in the United States with little more than the clothes on their backs and a fierce determination to build a better life. They don't have fancy degrees, deep pockets, or connections in high places. What they do have is something far more powerful: Dhandho. The word Dhandho, pronounced Dhandho, comes from Gujarat, India, and loosely translates to endeavors that create wealth. But here's the secret. It doesn't mean taking wild risks. Quite the opposite. Dhandho is all about minimizing risk while maximizing reward. It's the art of making calculated bets where the downside is limited, but the upside is massive. Nowhere is this philosophy more vividly illustrated than in the story of the Patel community and their domination of the motel industry in America. Back in the 1970s, waves of Patels began arriving in the U.S., many of them refugees expelled from Uganda by dictator Idi Amin. They needed a way to survive, and traditional jobs weren't an option due to language barriers and a lack of formal education. But they saw something most Americans didn't: struggling motels, sitting empty, waiting for someone to turn them around. Most people saw a failing business. The Patels saw an opportunity. They didn't buy flashy high-end hotels. Instead, they found rundown motels, often in foreclosure, and negotiated rock-bottom prices with desperate sellers. They lived in a small section of the motel, cutting out the need for hired staff. The whole family pitched in. Cleaning rooms, handling the front desk, fixing broken appliances. Labor costs? Nearly zero. Their investment was minimal, but their control over expenses was absolute. Here's where it gets really interesting. The motel industry is relatively stable. Business travelers, road trippers, and budget-conscious guests always need a place to stay. Even in economic downturns, these motels survived while high-end hotels struggled. The Patels had positioned themselves in a business with a low-risk, high-reward structure, exactly what Dhandho is all about. Let's talk numbers. A Patel family might buy a 20-room motel for $150,000 with a small down payment, financing the rest through a loan. Even if occupancy rates were low at first, they had such tight control over expenses that they could operate at a profit. Over time, they'd pay off the loan, reinvest earnings into another motel, and grow their empire. By the 1990s, Patels owned over half the motels in the U.S. Think about that. One small immigrant community came to dominate an entire industry, not through luck or massive risk-taking, but through a repeatable system of smart, low-risk investments with asymmetric upside. This is the essence of Dhandho. Find an opportunity where the risk is minimal, but the reward is substantial. Keep costs under control. Focus on businesses that are simple and easy to understand. Bet big when the odds are overwhelmingly in your favor. And here's the kicker. You don't need to own a motel to apply these principles. Whether you're investing in the stock market, starting a business, or making any financial decision, the Dhandho way is the key to stacking the odds in your favor. This is just the beginning of the journey. As we go deeper into the Dhandho Investor, we'll explore how to apply these principles in various investment strategies, from stock market plays to distressed businesses and even the wisdom of legendary investors like Warren Buffett. For now, just remember this: the road to wealth isn't about taking reckless risks. It's about finding bets where you have everything to gain and almost nothing to lose. That's the Patel Motel Dhandho, and that's how you build lasting wealth. Chapter 2. Manilal Dhandho. Imagine being a 19-year-old, leaving behind everything you know, stepping onto foreign soil with barely $1 in your pocket. That was Manilal Patel's reality when he arrived in the United States. Like thousands of other Patels, he had no job, no connections, and no roadmap to success. But what he did have was the Dhandho mindset, an almost instinctive ability to spot opportunity in adversity. Manilal's story begins in the late 1970s when he landed in the U.S. and found himself working dead-end jobs, just trying to make ends meet. He noticed that many of his fellow Patels were managing motels, a business model that seemed simple yet lucrative. Unlike fancy hotels, motels required minimal maintenance, had steady cash flow, and, most importantly, could be bought for dirt cheap if you knew where to look. Now, Manilal didn't have money, but he did have determination. He spotted a struggling 20-room motel that the owner was desperate to sell. It was the perfect setup for a Dhandho move: low risk, high reward. He negotiated a deal with the seller. He would take over the motel, run it himself, and pay the owner back over time from the profits. This was an ultimate heads, I win, tails, I don't lose much scenario. If the motel succeeded, he'd own a thriving business. If it failed, he'd walk away with minimal losses since he hadn't put in much of his own money. So, what did he do next? He and his wife moved into a small room at the back of the motel, eliminating housing costs. They cleaned the rooms, handled the front desk, and did all the maintenance work themselves. No need to pay employees. They cut every unnecessary expense and made sure that every dollar earned stayed within the business. Slowly but surely, occupancy rates improved. Truck drivers, budget travelers, and salesmen on the road started filling the rooms. The motel that everyone thought was doomed suddenly turned profitable. Within a few years, Manilal had not only paid off the previous owner, but also saved enough to buy another motel. Then another and another. Fast forward to today, and Manilal Patel, once a broke immigrant, owns multiple motels, lives comfortably, and has generational wealth to pass on. His journey is proof that wealth creation doesn't have to be about taking massive risks. It's about spotting undervalued opportunities, controlling costs, and playing the long game. Now, let's break down the core lessons from Manilal's story. 1. Buy assets with asymmetric risk-reward. Manilal didn't buy just any business. He bought a distressed motel where the risk was low because the owner was desperate to sell, and the upside was huge because a well-run motel could generate steady cash flow. That's the essence of Dhandho: finding bets where you risk little but stand to gain a lot. 2. Use other people's money, OPM, wisely. He didn't have money to buy the motel outright, so he structured the deal in a way that let him take control without putting up much capital. This is a common theme among great investors, whether it's Warren Buffett negotiating deals with little upfront risk or real estate moguls acquiring properties with seller financing. The key is to structure deals so that your downside is protected. 3. Cut costs ruthlessly. Instead of hiring a staff, Manilal and his family ran the motel themselves. Every dollar saved was a dollar reinvested into growing the business. This isn't just about being frugal. It's about ensuring your business survives long enough to thrive. 4. Play the long game. Wealth isn't built overnight. Manilal didn't stop after one motel. He reinvested profits into more properties, compounding his wealth over time. This is a fundamental principle of investing. Reinvesting gains to accelerate growth. 5. Find stability in chaos. When most people saw a failing motel, Manilal saw an opportunity. In every market, stocks, real estate, business, there are always distressed assets that can be turned around with the right approach. The key is to look beyond surface-level problems and identify assets with strong fundamentals that others are overlooking. This is what makes Dhandho so powerful. It's not about swinging for the fences or making reckless bets. It's about finding simple, stable businesses, minimizing risk, and letting time do the heavy lifting. Manilal Patel wasn't a financial genius. He didn't have an MBA or insider knowledge, but he understood the fundamental rule of wealth building. Find opportunities where the downside is limited and the upside is massive. This is the heart of Dhandho investing, and as we move forward in the Dhandho Investor, we'll dive deeper into how this principle applies to everything from buying stocks to acquiring entire businesses. For now, take a moment to think. Where in your life can you make a Dhandho move? Where can you take a small risk with the potential for a massive upside? That's where your wealth-building journey begins. Chapter 3. Virgin Dhandho. Let's take a trip back in time to the 1980s, when a young entrepreneur named Richard Branson was looking for his next big business venture. Branson, the founder of Virgin Records, had already made a name for himself in the music industry, but he wasn't satisfied. He wanted to break into a completely different field, aviation. That's right, he wanted to take on the airline giants like British Airways. Sounds like a crazy move, right? After all, airlines are one of the riskiest businesses out there. They require massive capital investment, have razor-thin profit margins, and are heavily dependent on factors beyond their control: fuel prices, government regulations, and economic downturns. Many airlines have gone bankrupt despite being run by experienced executives with deep pockets. So how did Branson, a music guy with zero experience in aviation, decide to start an airline without risking everything? Simple. He used the Dhandho Framework: minimize risk, maximize reward. Branson approached Boeing with a proposition: lease him a single aircraft, and if the airline didn't work out, he'd return the plane with minimal losses. In other words, he structured the deal so that if Virgin Atlantic failed, the downside was limited. He wouldn't be stuck with a fleet of airplanes or massive debt. But if it succeeded, he'd be in a position to scale up and compete with the big players. This is textbook Dhandho. Find a high upside opportunity where the risk is heavily reduced. Branson launched Virgin Atlantic in 1984 with just one plane. He focused on offering better service than existing airlines, comfortable seating, in-flight entertainment, and an overall enjoyable experience. His gamble paid off. Customers loved it. Virgin Atlantic quickly gained a reputation as an airline that cared about its passengers, and soon it was taking market share from the big players. Now let's break down the Dhandho principles at play in Branson's Virgin Airlines story. 1. Heads, I win. Tails, I don't lose much. Branson structured the deal with Boeing so that if the airline failed, he could walk away without catastrophic losses. This is classic asymmetric risk-reward, where the downside is capped, but the upside is unlimited. This is the exact same principle the Patels used in the motel industry. 2. Invest in simple businesses. Branson wasn't reinventing aviation. He simply took an existing business model and improved upon it. This is a crucial lesson. You don't have to innovate from scratch to succeed. Instead, find a business that already works and just make it better. 3. Look for hidden market inefficiencies. At the time, British Airways and other major carriers weren't focused on customer experience. Their service was subpar, and passengers were frustrated. Branson saw a gap in the market and capitalized on it. The best investment opportunities often come from spotting these inefficiencies that others ignore. 4. Scale up slowly. Branson didn't rush out and buy a fleet of planes. He started small, proved the concept, and then expanded. This incremental growth strategy allowed him to limit risk while testing the market. Contrast this with companies that overextend themselves too quickly and collapse under their own weight. 5. Use OPM, other people's money, wisely. Rather than raising massive amounts of capital and taking on huge debt, Branson leveraged a lease agreement. This way, he could control an expensive asset, a Boeing aircraft, without owning it. This is a powerful lesson for investors and entrepreneurs. Don't use your own money when you can structure a deal to use someone else's at low risk. What this means for investors. The Virgin Atlantic story is a perfect example of how the Dhandho approach applies to all types of businesses, not just motels. Whether you're investing in stocks, starting a business, or buying real estate, you should always ask yourself, can I structure this deal so that my downside is minimal, but my upside is huge? Am I investing in something simple and proven, rather than something overly complex? Is there a market inefficiency that I can exploit? Can I start small and scale up gradually? Am I using leverage or OPM in a smart way? Branson's Dhandho move, starting an airline without taking massive risks, shows that risk-taking is not the same as reckless gambling. True investors don't blindly bet everything on an idea. They carefully structure deals to limit losses while leaving the door open for massive gains. Virgin Atlantic is now one of the world's most recognized airlines, all because Branson played his cards the Dhandho way. He saw an opportunity where others saw obstacles. He minimized his risk while maximizing his upside. And most importantly, he understood that success isn't about taking massive leaps. It's about taking smart, calculated steps that keep you in the game long enough to win big. So as you think about your own investments and business ideas, ask yourself, where is my Virgin Dhandho opportunity? Chapter 4. Mittal Dhandho. Imagine a 26-year-old man from India standing in a small steel mill in Indonesia, staring at a business on the brink of collapse. Most people would have walked away, but this young man saw something different, an opportunity wrapped in crisis. His name? Lakshmi Mittal. Today, Lakshmi Mittal is one of the wealthiest steel magnates in the world. But his empire, ArcelorMittal, wasn't built through conventional means. He didn't start a steel company from scratch. He didn't bet on cutting-edge technology. Instead, he followed the Dhandho playbook. Buy distressed businesses for dirt cheap, turn them around, and scale massively. So how did he do it? It all started in 1976, when Mittal took control of a struggling steel mill in Indonesia. The business was in chaos, inefficient, unprofitable, and completely mismanaged. Most investors would have considered it a lost cause. But Mittal had a different perspective. He saw a business with a solid foundation where the real problem was bad management, not bad economics. Here's the key. The steel industry itself was not broken, only this particular mill was. That meant if he could fix operations, he'd have a profitable business. And since the owners were desperate to sell, he got the mill at an incredibly low price, limiting his downside. Now, Mittal wasn't just betting on one struggling steel plant. He was betting on a pattern, the idea that failing steel mills around the world could be revived with the right approach. Over the next few decades, he used this exact Dhandho strategy over and over again. 1. Find distressed steel plants that no one wanted. 2. Acquire them for a fraction of their real value. 3. Fix operations, cut costs, and improve efficiency. 4. Turn them into profitable businesses. 5. Repeat the process on a bigger scale. It was a brilliantly simple formula, one that transformed him from a small-time businessman into the largest steel producer in the world. Breaking down the Dhandho lessons. 1. Invest in distressed businesses in distressed industries. Mittal didn't chase trendy industries. He focused on boring essential businesses, steel mills that were failing due to mismanagement, not because steel itself was obsolete. This is a classic Dhandho principle. Go where others are too scared to go. When an industry is in distress, assets become cheap and the upside becomes massive. 2. Heads, I win. Tails, I don't lose much. Because Mittal was buying steel mills at rock-bottom prices, the risk was minimal. If a turnaround failed, he could sell off the assets and recover most of his money. But if he succeeded, the profits were enormous. This asymmetric risk-reward setup is exactly what smart investors look for. 3. Turnaround greater than innovation. A common mistake entrepreneurs make is thinking they need to invent something new to make money. Mittal proved that you don't have to reinvent the wheel. Sometimes just fixing broken businesses is far more profitable. Instead of trying to disrupt industries, he focused on restoring efficiency to existing ones. 4. Scalability and compounding. Mittal didn't stop after turning around one steel mill. He took the profits and reinvested them into acquiring more distressed mills. Each successful turnaround gave him the capital to buy the next one, compounding his growth exponentially. This is the same approach used by great investors like Warren Buffett, who reinvest profits into new opportunities rather than cashing out early. 5. Extreme cost control. Every turnaround involves slashing waste, optimizing production, and running operations lean. Mittal understood that $1 saved is $1 earned, and in industries with thin profit margins, cutting costs is often the easiest way to boost profits. The Dhandho Investor's takeaway. Mittal's strategy applies far beyond the steel industry. Whether you're looking at stocks, real estate, or small businesses, the key lessons remain the same. Look for undervalued businesses with strong fundamentals but poor management. Buy when everyone else is fearful and assets are selling for cheap. Fix inefficiencies instead of trying to create something brand new. Minimize risk by acquiring assets at bargain prices. Reinvest profits and scale up over time. Mittal wasn't a steel expert when he started, just like Richard Branson wasn't an airline expert, but he understood business fundamentals and applied a repeatable formula. The result? A multi-billion-dollar empire built on the simple, timeless principles of Dhandho investing. Now, think about your own investments. Are you chasing high-risk startups, or are you finding undervalued opportunities with hidden potential? Are you looking at market downturns as threats, or do you see them as opportunities? Mittal saw opportunity where others saw failure. That's the Dhandho way. Chapter 5. The Dhandho Framework. Investing can seem complicated. Wall Street analysts throw around jargon, financial reports are loaded with numbers, and experts debate endlessly about where the market is heading. But what if there was a simpler, more reliable way to approach investing, one that reduces risk while maximizing returns? That's exactly what the Dhandho Framework is all about. At its core, Dhandho investing follows a few fundamental principles that anyone can apply, whether they're buying stocks, starting a business, or making big financial decisions. Mohnish Pabrai distills this approach into a clear, repeatable framework, one that has made investors like Warren Buffett and Charlie Munger incredibly wealthy. It's based on low-risk, high-reward bets. Let's break it down. 1. Heads, I win. Tails, I don't lose much. This is the golden rule of Dhandho. Every investment should be structured so that if things go well, you make huge gains, but if things go wrong, you lose very little. Think about the Patel Motel owners. They put in minimal capital, often using OPM, other people's money, to buy motels that were already making money. Even if one business failed, their downside was small, but if it succeeded, the upside was enormous. Investors should always look for asymmetric bets, opportunities where the potential reward greatly outweighs the risk. Example: imagine you're buying a stock that's trading at $10, but you believe its real value is at least $30. If you're right, you triple your money. If you're wrong and the stock falls to $7, you only lose 30%. That's a Dhandho bet, high upside, low downside. 2. Invest in existing businesses. A huge mistake new investors make is trying to predict the future. They pour money into high-risk startups, speculative tech companies, or industries that haven't proven themselves. But Dhandho investors don't take those risks. Instead, they focus on businesses with a proven track record, companies that have been around for decades and have survived recessions, competition, and market crashes. Why? Because the future is unpredictable. It's much safer to invest in something that has already stood the test of time than to bet on an uncertain idea. Example: if you had to invest your life savings, would you put it into a brand new startup with no revenue, or into Coca-Cola, a company that has been making money for over 100 years? Dhandho investors always choose the sure thing. 3. Invest in simple businesses. The simpler the business, the easier it is to understand, and the less likely it is to fail. Think about a local laundromat versus a biotech startup. A laundromat has a straightforward business model. Customers pay to wash their clothes. There's no complex technology, no rapid changes in industry trends, and very little that can go wrong. Now compare that to a biotech company trying to develop a new drug. It relies on years of research, FDA approvals, expensive clinical trials, and constant innovation. If one thing goes wrong, the entire business could collapse. Dhandho investors avoid complexity. They stick to businesses that even a child could understand. Example: Warren Buffett famously said that he doesn't invest in businesses he can't understand. That's why he owns companies like Dairy Queen, Coca-Cola, and See's Candies. Simple, timeless businesses that don't require a PhD to analyze. 4. Invest in distressed businesses and distressed industries. Some of the best investment opportunities come when businesses or entire industries are going through hard times. When fear takes over the market, prices drop, but fundamentals often remain strong. Smart investors look for temporary problems, not businesses that are permanently broken, but those that are struggling due to short-term setbacks. Example: after 9/11, airline stocks crashed. People were afraid to fly and investors panicked, but airlines were not going to disappear. Those who bought airline stocks when they were cheap made huge profits as the industry recovered. 5. Invest in businesses with durable moats. A moat is something that protects a business from competitors. Think of it as a castle with a deep, wide moat. Enemies, competition, can't easily attack. Strong businesses have moats that make them hard to compete with. These could be brand loyalty. People trust Coca-Cola, Nike, or Apple more than competitors. Cost advantages. Walmart and Amazon can sell cheaper than smaller stores. Network effects. Facebook and WhatsApp are valuable because billions of people already use them. Dhandho investors look for businesses that can't easily be disrupted. If a company has a strong moat, it will keep making money for decades. 6. Few bets, big bets, infrequent bets. The average investor spreads their money across dozens or even hundreds of stocks, hoping that some will perform well. But Dhandho investors do the opposite. They wait for the right opportunity, then go big. Warren Buffett calls this punch card investing. Imagine you only had 20 investment decisions to make in your entire life. You would be extremely careful about choosing only the very best opportunities. Dhandho investors don't invest just for the sake of investing. They wait for a clear, high-reward, low-risk opportunity, then bet big. 7. Fixate on arbitrage. Arbitrage is when you take advantage of a price difference in the market. For example, Mittal bought steel mills in distressed countries where they were dirt cheap, but steel prices were high globally. By fixing those mills and selling steel at global prices, he created an instant profit. Dhandho investors look for hidden price imbalances, opportunities where something is undervalued in one place, but can be resold or used for more value somewhere else. 8. Always have a margin of safety. No investment is risk-free. That's why Dhandho investors always build in a margin of safety. They assume things might go wrong and they prepare for it. If a stock is worth $50, they don't buy it at $50. They wait until it drops to $25 or lower. That way, even if they were wrong about the valuation, their downside is protected. This is why Dhandho investing is low risk but high reward. You never pay full price for anything. You wait for discounts and buy at rock-bottom prices. Final takeaway. The Dando Framework is not about gambling or taking unnecessary risks. It's about finding opportunities with huge upside and minimal downside. Investing in proven, simple businesses. Buying when prices are low and fear is high. Focusing on a few high-conviction investments. Always protecting yourself with a margin of safety. This approach has been used by some of the greatest investors in history, from Warren Buffett to Lakshmi Mittal to Richard Branson. It's a simple but powerful formula, and it works. Now, the only question is, where is your next Dhandho opportunity? Chapter 6, Dhandho 101, Invest in Existing Businesses. When most people think of investing, they imagine high-risk startups, the latest tech innovation, or chasing the next big trend. But Dhandho investors see things differently. Why take unnecessary risks when you can invest in businesses that have already proven themselves? Mohnish Pabrai makes it crystal clear. Investing in existing businesses is one of the safest and smartest ways to build wealth. Instead of betting on uncertain futures, you can put your money into companies that have already stood the test of time. Let's explore why this principle is the foundation of Dhandho investing and how it can help you minimize risk while maximizing returns. 1. The startup illusion. Why new businesses are so risky. Imagine you're given two options. 1. Invest in a brand new restaurant with an exciting new menu, unknown chefs, and no customer base. 2. Buy an existing restaurant that has been profitable for 10 years, has regular customers, and a solid reputation. Which one is safer? The answer is obvious. Yet many investors make the mistake of putting money into new businesses with no track record, and they pay the price. Statistics tell a brutal story. 80% of startups fail within the first 5 years. Even after 5 years, most of the survivors don't make much money. Only a tiny percentage of startups become big successes. This is why Dhandho investors avoid startups. Instead of rolling the dice, they look for businesses that already make money and invest in them at the right price. 2. The Patel Motel model, a perfect example. The Patel Motel owners didn't start from scratch. They bought existing motels, often struggling ones, at dirt-cheap prices. The buildings were already there, customers were already coming in, and the infrastructure was in place. All they had to do was run the business more efficiently. By doing this, they minimized risk and maximized returns. They weren't gambling on an untested idea. They were improving something that was already working. This is the Dhandho way. Find something that's already making money and make it better. 3. Investing in public companies. The same principle applies. The stock market is full of thousands of businesses that already exist and have proven themselves. Why bet on a high-risk startup when you can invest in companies that have been profitable for decades? Take McDonald's as an example. It's been selling burgers since 1955. It has survived recessions, market crashes, and competition. It has a proven business model that works in almost any economic condition. Would you rather bet on a brand new burger startup with no history, or invest in McDonald's when the stock is trading at a discount? Dhandho investors always choose the safer, proven option. 4. The power of buying established businesses at the right price. Here's the real magic. You don't just invest in existing businesses. You invest in them when they're undervalued. Even great companies go through rough times. Maybe they face temporary problems or the market overreacts to bad news. This creates an opportunity to buy a strong business at a bargain price. Example: Warren Buffett and American Express. In the 1960s, American Express got caught in a scandal. Its stock crashed as investors panicked. But Buffett saw that the actual business, credit cards and financial services, was still strong. So he invested millions when the price was low. A few years later, the crisis passed, and the stock skyrocketed. His returns were enormous. This is classic Dhandho investing. Buy a proven business when it's temporarily beaten down, then wait for it to recover. 5. The key to success. Buy right, sit tight. Many investors make the mistake of constantly trading, chasing trends, and trying to predict short-term movements. Dhandho investors do the opposite. They wait for the right opportunity, a great business at a great price. They buy in large amounts once they're sure. Then they hold on patiently while the investment grows. This simple strategy has made Buffett, Pabrai, and other investors incredibly wealthy. 6. The takeaway. Focus on what already works. Dhandho investing is not about being a genius or predicting the future. It's about using common sense. Avoid high-risk startups. Most fail. Invest in businesses that already make money. Look for temporary problems that create low prices. Buy right, then sit tight. The next time you think about investing, ask yourself, is this business already proven? If the answer is no, walk away. If the answer is yes and the price is right, you've found your Dhandho opportunity. Chapter 7. Dhandho 102. Invest in simple businesses. Investing doesn't have to be complicated. In fact, the simpler the business, the better. Dhandho investors love businesses that are easy to understand, with straightforward operations and predictable cash flows. Mohnish Pabrai emphasizes that complexity is the enemy of good investing. If you need a PhD to understand how a business makes money, you're asking for trouble. Instead, stick to boring, time-tested businesses that generate cash consistently. Let's explore why simplicity is the key to successful investing and how to identify businesses that fit this model. 1. The problem with complex businesses. Imagine you're given two investment options. 1. A lemonade stand. You understand the costs: lemons, sugar, water, the revenue, selling lemonade, and the profit, what's left after expenses. Simple. 2. A biotech startup. It has 50-page financial reports, complex patents, uncertain FDA approvals, and research that may or may not succeed. Which one is easier to predict? The lemonade stand, of course. You know exactly how it makes money and what could go wrong. Now, apply this to the stock market. Many investors pour money into businesses they barely understand, like hedge funds betting on exotic derivatives or companies relying on futuristic technology. This is dangerous. If you don't understand how a company makes money, how will you know if it's a good investment? Dhandho investors avoid complexity. They invest in simple, predictable businesses that anyone can understand. 2. The power of simplicity in investing. Take Warren Buffett as an example. He loves investing in businesses with simple products: Coca-Cola, Dairy Queen, See's candies. Clear pricing power. Customers don't mind paying a little more. Steady demand. People will always drink Coke, eat candy, and consume ice cream. Buffett avoids industries he doesn't understand, like tech startups or biotechnology. He once said, "I don't invest in businesses I can't explain in a sentence." That's the Dhandho way. If you need a team of experts to explain a business, stay away. 3. Why complicated businesses fail more often. History is full of overly complicated businesses that crashed and burned. Enron, 2001. This energy giant had too many moving parts, obscure accounting practices, and a maze of financial tricks. Investors thought it was making billions until it collapsed in one of the biggest fraud scandals ever. Long-term capital management, 1998. A hedge fund run by Nobel Prize-winning economists. Their strategy was so complex that even they didn't fully understand the risks. When the market turned against them, they lost billions overnight. These examples prove one thing: if a business is too complex to understand, even the smartest people can get it wrong. Dhandho investors prefer businesses with simple, repeatable processes that don't rely on luck or financial engineering. 4. The best simple businesses to invest in. What does a great Dhandho-style simple business look like? Low innovation risk. It doesn't rely on constant new inventions to survive. For example, Coca-Cola. Consistent demand. People buy the product regardless of economic conditions. For example, insurance, utilities, fast food. Easy to understand financials. A quick look at the balance sheet tells you how it makes money. Here are some classic examples of simple businesses that have made investors rich. McDonald's. It sells the same burgers and fries all over the world. Nothing complicated, just a predictable, profitable business model. Southwest Airlines. Unlike other airlines, Southwest keeps things simple. One type of plane, no assigned seating, and a focus on efficiency. This simplicity helped it dominate the industry. See's Candies. Buffett bought this candy business because it had loyal customers, low overhead, and steady demand. Would you rather invest in a highly unpredictable tech company or a candy business that has sold the same chocolates for 100 years? Dhandho investors always pick the simple option. 5. How to identify a simple business. Before investing, ask yourself, 1. Can I explain this business in one sentence? Good. This company sells fast food at low prices and has thousands of locations. Bad. This company develops quantum computing algorithms for decentralized finance applications. 2. Do I understand how it makes money? Good. It sells coffee for $5 and makes a profit of $3 per cup. Bad. It generates revenue from AI-driven ad auctions based on predictive analytics. 3. Would I feel comfortable owning this business for 10 years? Good. People will always eat ice cream. Bad. This new tech might be obsolete in 2 years. If a business passes these tests, it's likely a good Dhandho investment. 6. The takeaway. Keep it simple. Stay rich. Most investors make the mistake of overcomplicating things. They chase hot trends, bet on futuristic ideas, and ignore the simple businesses that quietly make money year after year. Dhandho investing is about common sense. Simple businesses are easier to understand. Simple businesses are easier to manage. Simple businesses are less risky. The next time you consider an investment, ask yourself, do I fully understand how this company makes money? If the answer is no, walk away. If the answer is yes and the price is right, you've found a Dhandho opportunity. Chapter 8, Dhandho 201, Invest in Distressed Businesses, in Distressed Industries. If you've ever shopped at a clearance sale, you already understand the basic idea of Dhandho 201. Why pay full price for something when you can get it at a massive discount? In this chapter, Mohnish Pabrai explains why the best investment opportunities often come from businesses and industries that are in crisis. Most investors avoid these situations out of fear, but Dhandho investors see them as golden opportunities to buy valuable assets for pennies on the dollar. Let's dive into why distressed businesses and distressed industries are the perfect playground for Dhandho investing. 1. The stock market is irrational, and that's your advantage. Imagine a small town where a once thriving restaurant suddenly loses customers. Maybe a new competitor opened nearby, or a temporary health scare kept people away. The owner panics and decides to sell the business at a steep discount. But you, as a Dhandho investor, see the bigger picture. You know the restaurant has a loyal customer base, a great location, and solid long-term potential. The problem is temporary, not permanent. So you buy the restaurant at a huge discount, and within a few years, it recovers and thrives. This is exactly what happens in the stock market. Bad news causes panic and stock prices drop dramatically. Investors overreact, assuming the problems will last forever. Dhandho investors step in, buy at bargain prices, and profit when things recover. The key lesson? The stock market is often irrational. Fear and greed drive prices much more than logic. 2. The power of turnarounds, when a bad industry becomes a goldmine. History is full of examples of industries that looked doomed but later rebounded, making investors a fortune. Example 1. The U.S. steel industry. In the early 2000s, the American steel industry was in deep trouble. Foreign competitors like China were flooding the market with cheap steel, and many U.S. steel companies went bankrupt. Investors assumed the industry was dead. But a few years later, steel prices rebounded, demand surged, and companies like U.S. Steel X made a massive comeback. Those who bought steel stocks when everyone else was running away made huge profits. Example 2, the airline industry after 9/11. After the 9/11 attacks, airline stocks crashed. People feared flying, fuel prices were high, and major airlines were losing money fast. Many investors assumed the industry was doomed. Yet, over the next decade, air travel recovered, airlines restructured, and profits soared. Investors who bought airline stocks at rock-bottom prices made 5 times or 10 times returns. These stories teach us that industries don't stay bad forever. When things look their worst, it's often the best time to invest, but only if you do your homework and ensure the business can survive the downturn. 3. How to identify a great distressed business. Not all struggling businesses are worth investing in. Some never recover and go bankrupt. So how do you separate temporary problems from permanent disasters? Here's the Dhandho checklist for distressed businesses. Is the industry essential? If an industry is crucial to daily life, like food, transportation, or housing, it's likely to recover. If it's a trendy, fast-changing industry like fashion or tech startups, it might never bounce back. Is the company drowning in debt? Some companies collapse under heavy debt when times get tough. Look for businesses with manageable debt that can survive the downturn. Are competitors also struggling? If an entire industry is suffering, not just one company, it's often a sign of a temporary downturn rather than a permanent decline. Are there smart investors buying? If experienced investors or insiders are buying, that's a strong signal the company has potential. 4. The power of contrarian thinking. Why you must go against the crowd. Dhandho investing requires a strong stomach. You have to buy when everyone else is panicking. Most people run away from distressed industries. Dhandho investors see opportunity where others see disaster. You must have the courage to go against the crowd. Warren Buffett says it best. Be fearful when others are greedy, and greedy when others are fearful. Think about it. When a company is flying high, its stock is expensive and you risk overpaying. When a company is down and out, its stock is cheap and your potential reward is much higher. But remember, not every distressed company is worth investing in. Some businesses truly are doomed. That's why careful research is crucial. 5. Case study. Mohnish Pabrai's bet on Pinnacle Airlines. Pabrai shares a real-life example of how he applied Dhandho 201 in his own investing. Pinnacle Airlines, a regional carrier, was facing major financial trouble. The stock had dropped to almost nothing, and most investors believed it was going bankrupt. But Pabrai noticed something interesting. The airline had long-term contracts with major carriers like Delta and United. Even in bankruptcy, the business would likely survive under new ownership. The stock was trading so low that even a partial recovery would generate huge returns. So he took the risk and bought shares. What happened? Within a year, the stock tripled in value and Pabrai made a massive profit. By investing in a distressed business at the right time, he turned fear into fortune. 6. The takeaway. How to apply Dhandho 201 in your own investing. Distressed businesses and distressed industries are one of the best places to find bargain investments. But to succeed, you must look for industries that are temporarily struggling but still essential to daily life. Find businesses that can survive the downturn and come out stronger. Be brave when others are fearful, but also smart and selective. Dhandho investing is all about low risk, high reward. If you buy a business for 10 cents on the dollar, even a modest recovery can double or triple your money. Most investors panic during downturns, but Dhandho investors, they see downturns as opportunities to buy great businesses at clearance sale prices. That's the power of Dhandho 201. Buying when others are selling, staying patient, and reaping the rewards when the market rebounds. Chapter 9. Dhandho 202. Invest in businesses with durable moats. If you were planning to build a castle in ancient times, what's the first thing you'd want to protect it? A moat, a deep, wide trench filled with water or even alligators, making it extremely hard for enemies to attack. Now apply this same concept to investing. Businesses with strong moats are nearly impossible for competitors to destroy. They have lasting advantages that keep them dominant for years. sometimes even decades. In this chapter, Mohnish Pabrai explains why investing in businesses with durable moats is one of the smartest moves you can make and how to spot them. 1. What is a durable moat in business? A moat in business is a competitive advantage that keeps a company ahead of its rivals and protects its profits over the long term. Think about it. If you open a small grocery store and a big supermarket chain moves next door, your business is in trouble. But if you own Coca-Cola, no new soda brand can easily take your customers away. That's the power of a moat. The bigger the moat, the safer the business. Here's why moats matter in investing. Businesses without moats face constant threats from competitors. They might make money today, but there's no guarantee they'll survive tomorrow. Businesses with moats have lasting advantages. They can keep charging high prices, grow their profits, and withstand market downturns. Investing in companies with strong moats means you don't just make money, you make money for a long time. 2. The 5 types of durable moats. Not all moats are the same. Some are stronger and longer lasting than others. Pabrai highlights 5 key types of moats that make businesses nearly invincible. 1. Brand power, when customers trust a name. Some brands are so powerful that customers will pay extra just to buy their products. Coca-Cola. Even though cheaper sodas exist, millions of people refuse to drink anything else. Apple. People line up for hours to buy the latest iPhone, even when cheaper alternatives are available. Nike. The swoosh logo alone makes people feel like athletes, so they're happy to pay premium prices. A strong brand creates a psychological moat. Once customers trust a brand, it's extremely difficult for competitors to change their minds. 2. Network effects. The more users, the stronger it gets. Some businesses become more valuable as more people use them. Facebook, WhatsApp, and Instagram. Everyone uses them because their friends and family are on them. Amazon. Millions of sellers use it because that's where all the buyers are. Google. The more people use Google, the smarter its search engine becomes. These businesses get stronger over time, making it nearly impossible for new competitors to enter. 3. High switching costs. Too hard to leave. Some companies lock in their customers by making it difficult or expensive to switch to another provider. Microsoft Office. Many businesses rely on Word, Excel, and PowerPoint, and switching to another system would be a huge headache. SAP and Oracle. These companies provide business software that's deeply embedded in corporations. Switching would be costly and disruptive. Once a company's product becomes essential to its customers, they'll keep paying for it, no matter what. 4. Cost advantages, competing at a price. No one else can match. Some businesses become so efficient that competitors simply can't match their low prices. Walmart, its massive size, allows it to buy products cheaper than anyone else, keeping prices low. McDonald's, its supply chain is so optimized that it can serve millions of meals at unbeatable prices. These companies squeeze out competitors who can't afford to sell at such low margins. 5. Patents and legal protections. Monopoly by law. Some businesses own patents or have government protection that prevents competitors from copying them. Pharmaceutical companies. When a drug is patented, no one else can sell the same formula for years. Disney. It owns the rights to Mickey Mouse, Marvel, and Star Wars, preventing competitors from using those characters. Legal moats give companies temporary monopolies, allowing them to dominate markets. 3. Moats can disappear. Beware of weak moats. A common mistake investors make is assuming that a moat will last forever. But history shows that even the strongest businesses can lose their advantage. BlackBerry once dominated the smartphone industry. Then Apple and Android destroyed it. Kodak had a monopoly on film photography but failed to adapt to digital cameras. Yahoo, once the biggest search engine, now barely relevant. This is why Dhandho investors must always check if a company's moat is still strong. If competitors are catching up, the moat might not be as durable as you think. 4. How to identify businesses with durable moats. When analyzing a company, ask yourself, is it difficult for new competitors to enter the industry? Do customers willingly pay a premium for the product or service? Does the company keep growing stronger as more people use it? Would it be painful or costly for customers to switch to a competitor? Does it have legal protections or patents that give it an edge? The more yes answers you get, the stronger the moat. 5. Case study: investing in Moody's during the 2008 crisis. During the 2008 financial crisis, Moody's Corporation, a credit rating agency, saw its stock price crash. Many investors feared it was doomed, but Pabrai saw something different. Moody's had a monopoly-like position in the credit rating industry. Its brand was trusted worldwide, and businesses needed its services. It was a legal requirement for many financial institutions to get rated by Moody's. Despite the temporary panic, Moody's had a massive moat. Pabrai bought shares at rock-bottom prices, and as the crisis passed, Moody's stock skyrocketed. This is the power of investing in a business with a durable moat. It survives tough times and comes back even stronger. 6. The takeaway: how to apply Dhandho 202 in your investing. Businesses with durable moats are the safest and most profitable long-term investments. To succeed, focus on companies that have a powerful brand that customers love, a network effect that keeps growing stronger, high switching costs that make it hard to leave, cost advantages that crush competitors, legal protections or patents that prevent competition. And remember, moats don't last forever. Always check if a company's moat is still intact before investing. The best investments are in businesses that dominate their industries and stay dominant for decades. These are the companies that make fortunes for patient investors. That's the essence of Dhandho 202, investing in businesses with durable moats and enjoying low-risk, high-reward returns over time. Chapter 10. Dhandho 301. Few bets, big bets, infrequent bets. Imagine you're at a high-stakes poker table. You don't bet on every hand. Instead, you wait for that one perfect opportunity, a hand so strong that it's almost impossible to lose. When it comes, you go all in. That's exactly how great investors operate. In this chapter, Mohnish Pabrai introduces Dhandho 301, a powerful investment principle. Make a few bets, make them big, and don't make them often. This is how investors like Warren Buffett, Charlie Munger, and Pabrai himself achieve incredible returns while keeping their risks low. 1. Why diversification is overrated. Most financial advisors preach diversification, spreading your money across many stocks to reduce risk. But here's the problem. The more stocks you own, the harder it is to track them. Your best ideas get diluted. You end up owning many average companies instead of a few great ones. Charlie Munger puts it bluntly, if you see a great investment, why put money into your 20th best idea instead of putting more into your best idea? Great investors don't bet on everything. They wait for rare opportunities and bet big. 2. The power of concentrated investing. Pabrai shares an interesting statistic. Warren Buffett made over 90% of his wealth from just 10 investments. Think about that. Out of thousands of stocks he could have chosen, just 10 made him a billionaire. That's because Buffett and Munger follow a simple rule. Find a business with a high probability of success. Wait for the stock price to drop below its true value. Invest a big chunk of your portfolio into it. Then sit back and let it compound over time. This strategy works because great investment opportunities don't come around often. When they do, you must bet big. 3. The Kelly Formula: How to Size Your Bets. Now, you might be wondering, how much should I bet on a single stock? Pabrai introduces the Kelly Formula, a betting strategy used in casinos and financial markets. It calculates the optimal bet size to maximize returns while minimizing risk. The simplified version of the formula is edge/odds equals ideal bet size. For example, if you're investing in a stock where you estimate the upside is 3 times 300%, the downside is 50% if you're wrong, you believe there's an 80% chance you're right. Your ideal bet size would be open parenthesis 0.8 times 300%, close parenthesis minus open parenthesis 0.2 times 50% close parenthesis equals 220%. This suggests betting a significant portion of your portfolio. Buffett and Munger follow this approach intuitively. They bet big when the odds are overwhelmingly in their favor. 4. Case study: Pabrai's big bet on Fiat Chrysler. In 2012, Fiat Chrysler FCA was trading at a ridiculously low valuation. Most investors ignored it because the auto industry was struggling. Chrysler had just come out of bankruptcy. The company wasn't paying dividends, but Pabrai saw an incredible opportunity. Fiat's CEO, Sergio Marchionne, was a genius at turning around businesses. The company owned Ferrari, Jeep, and Maserati, brands with strong moats. The market was underestimating its potential. Pabrai made a massive bet on FCA. A few years later, Fiat's stock skyrocketed, and Pabrai made over 5 times his money. This is the essence of Dhandho 301. Find rare, high-probability bets and go big. 5. Why most investors fail: the fear of concentration. The biggest reason most investors don't make big money: they fear concentration and spread their bets too thin. Pabrai compares it to a game of chess. Imagine a grandmaster playing 50 games at the same time. They might win a few, but they'll make far more mistakes than if they focused on just 1 or 2 games. Investing is the same. Instead of buying 50 stocks, why not put more money into the 3 to 5 best opportunities? Chapter 11. Dhandho 302. Fixate on arbitrage. Imagine you walk into a store and find a product selling for $50. A few blocks away, the same product is priced at $100. You buy it for $50, sell it for $100, and pocket the difference. That's arbitrage, a virtually risk-free way to make money. Now, what if I told you the stock market regularly offers similar opportunities? In this chapter, Mohnish Pabrai explains how fixating on arbitrage, finding and exploiting market mispricings, is a crucial part of Dhandho investing. 1. Understanding arbitrage. Making risk-free profits. Arbitrage exists when 2 identical or nearly identical assets are priced differently in different markets. For example, currency arbitrage. Suppose $1 is worth 0.92 euros in the US, but 0.94 euros in Europe. A trader can buy dollars in the US, convert them in Europe, and pocket the difference. Merger arbitrage. If a company announces it will acquire another at $50 per share, but the target company's stock is still trading at $47, an investor can buy at $47 and earn a risk-free $3 when the deal closes. Pabrai argues that value investing itself is a form of arbitrage. When you buy a stock for $50 that is truly worth $100, You're taking advantage of a temporary mispricing and waiting for the market to correct it. This is what great investors do. They find these price discrepancies and profit from them. 2. The mispricing of risk. Finding low-risk, high-reward bets. The stock market is not rational. It's driven by fear, greed, and short-term thinking. When a company experiences temporary bad news, investors panic, dumping the stock far below its true worth. This is where arbitrageurs step in. Take Warren Buffett's famous American Express investment. In 1963, Amex got caught in the salad oil scandal. A company it had loaned money to had used fake inventory, barrels filled mostly with water, as collateral. Investors panicked and the stock plunged by 50%. Buffett analyzed the situation and realized Amex's core business, credit cards and financial services, was completely unaffected. He made a massive bet on Amex, and within a few years, the stock recovered and soared, making him a fortune. This is Dhandho arbitrage, finding low-risk, high-upside investments that others are too scared to touch. 3. The Patel Motel arbitrage, turning cheap motels into gold mines. The Patel motel empire is a perfect example of arbitrage in action. Most Americans saw motels as risky and undesirable businesses. The Patels saw an undervalued opportunity, low competition. Few people wanted to manage motels. Distressed prices. They bought struggling motels at rock-bottom prices. Operational efficiency. They cut costs by managing everything themselves, often living on site. While others ran away, the Patels leaned in and exploited the mispricing. They weren't taking real risks. They were exploiting market inefficiencies and using arbitrage thinking to build a fortune. This is the same mindset great investors use. Look for assets that are temporarily underpriced but have long-term value. 4. Time arbitrage. Why patience is a superpower. Most investors are too impatient. They want quick profits, and when stocks don't move fast, they sell too early. But long-term investors can take advantage of this time arbitrage, buying great businesses when they're cheap and simply waiting for the market to recognize their value. For example, in 2008, during the financial crisis, stocks crashed. Berkshire Hathaway, Coca-Cola, Google, and Apple were all trading at massive discounts. Investors panicked and sold in fear. But those who bought and held on saw huge returns over the next decade. Patience multiplies wealth. Great investors buy at a discount and let time do the heavy lifting. 5. The role of luck in arbitrage. While arbitrage can be highly profitable, Pabrai warns that it's not always predictable. You can control the process, finding mispriced opportunities. But you can't control when the market corrects the mispricing. Sometimes the market takes months or years to recognize an undervalued asset. That's why investing requires patience. Buffett says, the stock market is a device for transferring money from the impatient to the patient. If you master arbitrage, you'll be the one collecting money from the impatient investors who sell too soon. Chapter 12. Dhandho 401, Margin of Safety. Always. Imagine you're about to cross a rope bridge over a deep canyon. Would you feel safer if the bridge was built to handle exactly your weight, or if it was designed to hold 5 times your weight? The second bridge, of course. That's the margin of safety, a crucial principle in investing. In this chapter, Mohnish Pabrai emphasizes that successful investing isn't about making perfect predictions. It's about buying so cheaply that even if things go wrong, you still win. 1. What is margin of safety? The margin of safety is the gap between a stock's price and its true value. If a stock is worth $50 and you buy it for $40, you have a 20% margin of safety. If you buy it for $25, your margin of safety is 50%, a much safer bet. This principle was first introduced by Benjamin Graham, the father of value investing, and later perfected by Warren Buffett. Pabrai follows the same rule. Only invest when there's a huge gap between price and intrinsic value. Why? Because even if some things go wrong, you still make money. 2. The car analogy. Would you pay full price? Let's say you're buying a used car. You find one worth $10,000, but the owner is desperate and willing to sell it for $5,000. Would you take the deal? Absolutely. Even if you later find out the car needs $2,000 in repairs, you still got a great bargain. That's how margin of safety works in investing. Buy at a big enough discount that even if unexpected problems arise, you still win. But what if you had paid full price? Then even small problems could wipe out your profit. 3. Buffett's rule. Heads I win, tails I don't lose much. Warren Buffett only makes bets where he can't lose big. He calls it heads I win, tails I don't lose much. That's the power of margin of safety. If things go well, you make a fortune. If things go badly, you still break even or make a small profit. Pabrai learned this firsthand when he invested in Frontline Limited, a shipping company. The company's stock was worth $30 per share. But in 2001, shipping rates crashed and the stock plunged to $4. Pabrai analyzed the business and realized the company wasn't going bankrupt. It was just experiencing a temporary downturn. He bought shares dirt cheap, and within 2 years, Chapter 13. Dhandho 402. Invest in low-risk, high-uncertainty businesses. Imagine walking into a casino where you always win in the long run, but the short-term results are unpredictable. Wouldn't that be the best business to invest in? That's exactly what low-risk, high-uncertainty businesses offer. In this chapter, Mohnish Pabrai explains why most investors wrongly confuse risk with uncertainty and how smart investors profit from this confusion. 1. The difference between risk and uncertainty. Most people believe that high uncertainty equals high risk, but this is often false. Risk is the possibility of losing money permanently. Uncertainty is not knowing what will happen next. The stock market hates uncertainty. When a company faces temporary bad news, investors panic and dump the stock, even if the long-term risks are low. That's when smart investors step in and scoop up bargains. High uncertainty creates mispriced stocks. Low-risk businesses with temporary uncertainty become the best investments. 2. The Indian wedding hall arbitrage. Imagine you live in India, where big, elaborate weddings are common. You notice a wedding hall business for sale. The previous owner went bankrupt because he mismanaged the business. But you do some research and realize demand for wedding halls is still strong. You buy the business at a huge discount because others are scared. In this case, the risk is low because people will always need wedding venues. The uncertainty is high because no one knows if the hall will be profitable next year. If you buy it cheap enough, you make money even if the business takes time to recover. That's the essence of low-risk, high-uncertainty investing. 3. Pabrai's investment in IPSCO. Mohnish Pabrai made a huge bet on IPSCO, a steel company that Wall Street had completely ignored. In 2003, IPSCO stock was trading at $45. But the company had $15 per share in cash and was earning $15 per share in profits. Pabrai realized that even if steel prices collapsed, IPSCO was still a low-risk investment. He bet big and made a 4 times return in less than 2 years. Most investors ignored IPSCO because steel prices were unpredictable. but Pabrai saw the low-risk opportunity hidden inside the uncertainty. 4. The power of buying cheaply. A low-risk, high-uncertainty bet only works if you buy it cheap enough. Imagine two investors. One investor, A, buys a business worth $100 million for $90 million. Not much margin of safety. Investor B buys the same business for $20 million. Huge margin of safety. If things go wrong, investor B still wins because he bought at a massive discount. Investor A loses money because he didn't have enough margin for error. That's why buying at deep discounts is the key to Dhandho investing. 5. The lesson: ignore the noise. Focus on value. Most investors run away from uncertainty. Smart investors embrace it. Whenever you see a great business facing temporary uncertainty, ask yourself, is the business fundamentally strong? Is it actually risky or just uncertain? Can I buy it dirt cheap? If the answer is yes, you've found a low-risk, high-uncertainty Dhandho bet, a perfect investment. Chapter 14. Dhandho 403. Invest in the copycats rather than the innovators. Imagine you're in a gold rush. Who makes the most money? Is it the gold miners who risk everything digging for gold? Or is it the shopkeepers who sell them the shovels? The answer: the shopkeepers win. This is the core lesson of Dhandho 403. Invest in copycats, not innovators. In this chapter, Mohnish Pabrai explains why copying a proven business model is far less risky than trying to invent something new. 1. Why innovation is risky. Most people believe that innovation leads to huge profits, but in reality, most innovators fail. Take the automobile industry. Henry Ford revolutionized the car industry in the early 1900s. But hundreds of other car companies went bankrupt trying to compete. Or look at airlines. The Wright brothers invented the airplane. But most airline companies have struggled or gone bankrupt over time. Innovation is expensive, unpredictable, and comes with huge risks. That's why smart investors don't bet on pioneers. Instead, they invest in businesses that copy proven ideas and execute them better. 2. The McDonald's example. Who really won? The fast food industry is a perfect case study. White Castle was the first fast food burger chain in the U.S. in 1921, but the real winner was McDonald's, which copied the idea and scaled it. McDonald's didn't invent fast food. They just perfected the system, franchised it, and built an empire. Similarly, Sam Walton didn't invent retail, but he studied other stores and created Walmart, the biggest retailer in the world. The real money isn't in being first. The real money is in copying, improving, and scaling a proven idea. 3. The Microsoft Playbook, a masterclass in copying. Bill Gates built Microsoft into a trillion-dollar company, but did Microsoft invent anything? No. They copied Apple's graphical user interface and made Windows. They copied IBM's business model and dominated enterprise computing. They copied other companies' software ideas and improved them. Microsoft is one of the richest companies ever, not because they invented, but because they executed better than others. 4. The Richard Branson approach. Copy and expand. Richard Branson, the billionaire behind Virgin Group, follows the same playbook. Branson never tries to reinvent an industry. Instead, 1. Finds a successful business model. 2. Copies it. 3. Adds a unique touch. 4. Scales it fast. That's how Virgin Airlines, Virgin Mobile, and Virgin Money all became huge successes. Branson never takes the risk of inventing something from scratch. He just improves existing models. 5. Pabrai's investment in Ferrari's copycat. Mohnish Pabrai applied this lesson when investing in Fiat Chrysler, FCAU. Ferrari, the luxury sports car company, was spinning off from Fiat Chrysler. Ferrari had huge brand value, but its stock was overpriced. Fiat Chrysler, on the other hand, was dirt cheap and still owned Ferrari before the spin-off. Pabrai bought Fiat Chrysler, knowing that once Ferrari was separated, Fiat Chrysler's hidden value would be unlocked. Instead of betting on Ferrari, the innovator, he bet on the copycat. Chapter 15. Abhimanyu's Dilemma, the Art of Selling. Imagine you've made a brilliant investment. You bought a stock at a huge discount, and now it has doubled in value. What do? Sell it and lock in your gains? Hold it and hope it keeps going up? Buy more because it's a winner? This is Abhimanyu's dilemma. You know how to enter the battlefield, buy a stock, but you don't know how to exit when to sell. In this chapter, Mohnish Pabrai explains why selling is one of the hardest decisions in investing and how to do it right. 1. The curse of selling. Too early. One of the biggest mistakes investors make is selling too soon. You buy a stock for $10 and it goes up to $20. You sell it thinking you've made a great profit, but then the stock keeps rising to $50, then $100. Pabrai gives the example of Warren Buffett's biggest regret, selling Disney too early. In 1966, Buffett bought 5% of Disney for $4 million. A year later, he sold it for a 50% profit, thinking he had made a great deal. Today, that stake would be worth over $10 billion. The lesson: great businesses compound over decades. Selling too soon can be far more costly than holding. 2. When should you sell? Pabrai follows 3 clear rules for selling. Rule 1. Sell when the business fundamentals have deteriorated. If the reason you bought the stock is no longer valid, get out. The company's competitive advantage has disappeared. The management is making terrible decisions. The industry is in a long-term decline. Example: if you had invested in Kodak in the 1990s because they dominated film photography, you should have sold when digital cameras took over. Rule 2. Sell when the stock becomes overvalued. If a stock rises too fast and becomes extremely expensive, selling might be smart. If you bought a stock at 5 times earnings and now it trades at 50 times earnings, it's probably time to exit. This is especially true if growth prospects are slowing down. Example: Pabrai invested in Fiat Chrysler when it was ridiculously cheap. As the stock doubled and tripled, he analyzed its fair value. When it hit its intrinsic value, he sold and moved on to better opportunities. But beware, just because a stock rises doesn't mean it's overvalued. Rule 3. Sell when you find a much better investment. If you find a new stock with much higher upside and you have no extra cash, it can make sense to sell a good investment to buy a great one. If stock A has a 50% upside but stock B has a 200% upside, you might reallocate your money. This is how great investors like Buffett, Pabrai, and Munger maximize returns. 3. The emotional battle of selling. Selling is not just about logic. It's also about controlling emotions. Fear makes you sell too. Chapter 16. To index or not to index? That is the question. For most people, investing is confusing. There are thousands of stocks, different strategies, and endless opinions on what to buy. So a simple question arises. Should you invest in individual stocks like Warren Buffett, or should you just buy an index fund and forget about it? This chapter dives into the debate between active investing, picking stocks, and passive investing, index funds. 1. The case for index investing. Most people are not professional investors. They don't have time to read financial reports, study businesses in detail, track the market daily. For them, index funds offer an easy way to invest without stress. They own a little piece of every big company. They require zero effort. Just buy and hold. They outperform most professional fund managers over the long run. Even Warren Buffett recommends index funds for most people. He told his wife, "When I die, put 90% of our money in a low-cost S&P 500 index fund." 2. Why active investing can be better if you do it right. Pabrai argues that index investing is great for most people, but not for everyone. If you're willing to put in the effort, stock picking can deliver far better returns than an index fund. Index funds give average returns, about 8 to 10% per year. Great stock pickers like Buffett and Munger earn 20% plus per year. A 20% return doubles your money every 3.6 years. A 10% return takes 7.2 years to double. The difference is massive over time. Example: if you invest $10,000 at 10% per year, in 30 years, you'll have $174,000. If you invest $10,000 at 20% per year, in 30 years, you'll have $2.3 million. The lesson: if you have no time or interest in investing, choose an index fund. If you are willing to learn and study businesses, you can beat the market. 3. Why most people fail at stock picking. Even though stock picking can be more profitable, most people fail at it. Why? 1. They trade too much, incurring high costs. 2. They let emotions take over, buying high, selling low. 3. They don't do proper research, picking stocks randomly. Pabrai emphasizes that stock picking only works if you follow the Dhandho Framework. Look for high upside, low downside. Invest only in simple, understandable businesses. Wait for the right price. Buy only when stocks are dirt cheap. If you can stick to these principles, active investing can crush index funds. 4. The hybrid approach, a middle ground. If you're unsure whether to index or pick stocks, there's a middle path. Put 90% of your money in a low-cost index fund. Use the remaining 10% for stock picking. This way, you get check market returns from indexing for safety. Check a chance for higher returns from stock picking, if you're good at it. Over time, if you realize you're good at finding undervalued businesses, you can shift more money toward active investing. Final takeaway: to index or not to index? The answer depends on your effort and discipline. If you want easy, stress-free investing, go with an index fund. If you're willing to study businesses deeply, stock picking can lead to massive wealth. Either way, the key is to stay invested for decades, because time is the ultimate wealth builder. Chapter 17. Arjuna's Focus, Investing Lessons from a Great Warrior. In the epic Mahabharata, there's a famous story about Arjuna, the greatest warrior of his time. One day, his teacher Dronakarya set up a test for his students. He placed a wooden bird on a tree and asked each student to aim at its eye. Before they could shoot, he asked, "What do you see?" Each student responded, "I see the tree, the branches, and the bird. I see the sky, the leaves, and my target." Drona shook his head and didn't let them shoot. Finally, he asked Arjuna. Arjuna said, "I see only the bird's eye, nothing else." Drona smiled and said, "Shoot!" Arjuna fired and hit the target perfectly. 1. The power of focus in investing. Pabrai argues that great investing requires Arjuna-like focus. Most investors get distracted by news headlines, short-term stock price movements, fear, and greed. But the best investors ignore all noise and focus only on one thing: the long-term value of the business. Like Arjuna focusing on the bird's eye, you must fixate on intrinsic value and ignore everything else. 2. The pitfall of too many stocks. Most investors own too many stocks. They think diversification protects them. But Pabrai argues that too much diversification dilutes returns. If you own 50 stocks, even if one becomes a 10x winner, it barely moves your portfolio. But if you own 5 to 10 carefully chosen stocks, a few big winners can make you extremely wealthy. Warren Buffett says, "Wide diversification is only required when investors do not understand what they are doing." Instead, he suggests, buy only your best ideas. Concentrate on high-conviction investments. Hold them for the long term. 3. The 80-20 rule in investing. Pabrai highlights the Pareto principle, 80-20 rule. 80% of your returns will come from 20% of your investments. This means instead of spreading your money thin, focus on a few outstanding businesses. Instead of watching hundreds of stocks, study a few deeply. Checkmark. Instead of trading frequently, hold your winners for decades. Example, Charlie Munger made billions by focusing on a few key investments. Coca-Cola, See's Candies, Costco. He didn't invest in 100 companies. He focused on a handful of great businesses. 4. Avoiding distractions in a noisy market. The stock market is like a battlefield, filled with distractions. Investors are bombarded with daily stock price updates, media hype and fear-mongering, experts predicting crashes or booms. But great investors block out the noise. They focus only on intrinsic value. They ignore short-term price movements. They make fewer but bigger bets on great businesses. Like Arjuna, they see only the target, not the distractions around it. Final takeaway. Arjuna became the greatest warrior because of his unshakable focus. Great investors become wealthy by applying the same principle to investing. Ignore distractions. Focus only on long-term business value. Own only your best ideas. Don't over-diversify. Let your winners compound for years. Don't sell too soon. Master Arjuna's focus, and you'll master the Dhandho way of investing. Conclusion, the Dhandho way to wealth. So, what have we learned from the Dhandho Investor? At its core, Dhandho investing is about playing a smart, calculated game, where risk is low but rewards are high. It's about thinking like a Patel Motel owner, like a savvy entrepreneur, and like a great investor who sees opportunity where others see fear. Throughout this book, Mohnish Pabrai has given us a proven blueprint for wealth creation. Buy businesses when they are undervalued and beaten down. Look for high upside with minimal downside. Focus on simple, predictable businesses with durable moats. Be patient. Investing is a marathon, not a sprint. Make few but high conviction bets. Big opportunities don't come often. And most importantly, avoid unnecessary risks and protect your capital. These principles are simple yet powerful. They have been used by legendary investors like Warren Buffett, Charlie Munger, and Pabrai himself to build fortunes. But here's the real question. Will you apply them? Because knowledge alone won't make you rich. Action does. If you truly want to achieve financial freedom, it's time to start thinking and investing the Dhandho way. Find businesses that are temporarily struggling but have strong fundamentals. Look for asymmetric bets, where downside is limited but upside is massive. Stay patient, stay disciplined, and let compounding do its magic. Now, it's your turn. What was your biggest takeaway from the Dhandho Investor? Which lesson resonated with you the most? Let's continue the conversation in the comments. And if you enjoyed this deep dive, don't forget to like, share, and subscribe for more insightful content on investing, business, and wealth building. Thanks for tuning in, and remember, heads I win, Tails, I don't lose much.